There was sweeping changes to the Income Tax Act a number of years ago that affected business owners and their families. What are the potential tax implications do you think in today's world that they should be mindful of?
Okay. So I remember, well, it's 2017, the Liberal government had introduced some rules that really hit small private corporations. So what they were doing is they were looking at income splitting rules, and most people have dealt with those. And then there was also an impact to passive income rules. So passive income is investment income. So what happens within your typical private corporation is that on its active business income, so the business portion of its income, it gets a very low tax rate on the first $500,000 of that active business income. And because it has such a low tax rate, some of these corporations, there's a perception we're able to build up large investment balances inside the corporation. So what the rules did is they introduced, and we call them the passive income rules, is that when there's passive income with inside the corporation, the private corporation exceeds $50,000, the low tax rate on that $500,000 of active business income, that $500,000 gets ground down. So what's happening is that business owners or who have a large investment balance inside their corporation are watching that passive income very closely. So they want to make sure that they're below that $50,000 level of investment income. The more technical term is passive income, but for our purposes, we'll call it investment income. So they're watching what interest are they making, what capital gains, what dividend income are they making. And as we were talking earlier, if that if that capital gain inclusion rate increases to 75%, well, that could impact that $50,000 threshold. So business owners are thinking about this too. Now, many business owners may not be aware for when it's coming to non-registered investments, thinking about corporate class funds. There's just a potential for lower distributions and more tax efficient distributions. So it's an opportunity for them to try to stay below that $50,000 of passive income so they can keep their full low tax rate on the full amount of the small business income.
I think actually what you say is brilliant, and not many Canadians actually keep this in mind. It's not necessarily what you earn, but what you keep in your pocket. So within a corporation, what we find is if you can have either tax deferral investments or capital gain producing investments, obviously those are advantageous. And outside of investment portfolios, there are other tax strategies that should be considered that I know we've done with our clients as well. They get the best of both worlds. They get the growth of an investment, but they also get the tax deferral, which doesn't impact their passive income, which is ideal. So now tell me a little bit about, obviously individuals with the holding company, they grow those assets over time, and succession planning often doesn't occur in their lifetime. So they actually end up dealing with their tax liability come estate time. What would your comments be about how they can address that maybe today or come estate time to help offset that and just leave a larger, and I don't want to say gift, but a lot of their hard work to the family that they've been supporting all those years, or if not family, even charities or other family members, beneficiaries, or what have you.
Well, this is where someone has, so they've completed their business operating within that company and is primarily an investment holding company. So they have their corporation, it's holding their investments. As we talked about, on death, you're deemed to dispose of your investments as an individual. So that means that you're deemed to dispose of the shares of that corporation. So I want to go into a bit of the detail. So the estate of the deceased would pay the capital gains associated with the shares, deemed disposition of the shares of that corporation. But then there's a second layer of what happens is that at some point, the corporation is going to sell those underlying investments inside the corporation. So that then the corporation is paying tax on those investments as well. So what that leads to is a double tax situation. where the individual is paid with the estate of the individual's paid tax, as well as then the corporation is paying tax on that. And when the corporation pays a dividend to the new shareholders, the beneficiaries, they're going to pay tax on that. So what I'd like, and if anybody's in this situation, is to one, be aware that there is a situation here. Talk to a financial advisor, talk to their tax accountant, think about what can we do to avoid this. And there's various strategies. There's an insurance strategy that could be used to pay off the taxes. There's strategies. It's called I don't want to use the word meltdown, but you're switching it over time. That could be done to do that. But there are strategies to avoid the double taxation. Now, it's always easier to do these before death than it is to do it after death. So it's often an ounce of prevention is worth it, Pam here.